So welcome to this webinar hosted by Opes Trading Group. I'm Philip Saloom, as you all might know. And what I'm going to do today is just do a little webinar on FX, and I'm going to pretty much break down Euro AUD. So as you guys might know or might not, my favorite pairs to trade are Euro AUD, GBP AUD, and GBP JPY. So what I'm going to do today is do a top-down analysis on Euro AUD. I'm going to go back in time as well, so I can show you guys how to actually look at technical analysis from my point of view and how I do it myself, and pretty much answer any questions you guys might have. So before we get started, just open up your chats in the Zoom, and I want you guys to tell me what level of trader you would consider yourself. 1 being a beginner to 10 being professional. So let's get started by you guys telling me what type of trader or, your level as a trader. And also, I want you guys to tell me if you're a fundamental or a technical type of trader, or if you're both. Okay, so from what I can see, we've got a range of people in terms of their trading levels. Both, yep, that's good. Beginner, okay, perfect. So this is going to be beneficial to all of you guys. Everyone's a technical trader. It's great. I do use fundamentals. However, I do focus on the technical aspects. So today what I wanted to do is show you guys the technical tools I look at, and how retail traders are a lot of the time. They are trapped, you could say, in technical tools that might help them sometimes. However, they might find that they are falling into that trap where they're using these tools and they're not working. So I'm going to go and show you Euro AUD. Let's look at it firstly on the daily time frame. What we can see from way back in March 2020, this is when the COVID first began, you could say. And the AUD lost a lot of its strength against the majority of pairs. So you can see here against the Euro gained a lot of strength against the AUD. And then we topped at this high right there. And then we started finding ourselves moving in quite a bearish market for some time. So all the way from March 2020 into February 21. So it's pretty much 1 full year where the market just moved to the downside. Now, if we're looking at this, basic technical analysis would tell you to use something like a trend line, where you would draw, let's get our array, you would draw a line, something like this, and you would say, okay, you have a 0.1, 0.2. This is going to be a bit confusing to you guys because you're seeing this, and then you might adjust it to this point, and then you might think, okay, this is working, I've got a tap there, but then this broke, and it kind of doesn't make much sense to you. And then what you do is, some people might draw another trend line from this point down, and then I say I've got 0.1, 0.2, I've got a 0.3, 0.4 touch, which did work beautifully in this instance. First things first, guys, you're not going to be trading daily time frame. You're not going to be taking trades much off a daily time frame unless you're a swing trader who's willing to have very large stop losses, large CPs, a lot of capital and equity, because you need to be able to hold the trade and to place your stop losses above key areas. So the first thing I want to tell you is, in technical analysis, the way I do it is I look at trend lines. The main key word out of trend lines is trend. I'm not too fussed about the line. I'm not fussed about what this line is showing me. I'm not fussed if it's tapping 3, 4. I just want to see what type of trend we are in. And that's what a majority of traders forget. They think that just because a trend line's broken, we have shifted momentum. And that can actually portray something very incorrect on the charts, because it might break to the upside here from this point. However, if it doesn't break that previous high right there, you didn't technically shift structure at all. So a lot of people see this little trend line breaks and they automatically assume that the market's going to switch into the other way, and they start taking buys, only for the market to, do something like this, where it breaks above the trend line like here and then comes back in. And then once again, it breaks above the trend line and comes back in. So first thing I use, trend lines for in my technical analysis is purely for looking at trends and nothing else. Then what I do have is what I call my major and minor supply and demand areas. So if we look at, this high, which I would say is, a swing high, we've got a swing low down here. And what we would do is look at this area as a major supply area, and we would look at this area as a major demand. And now all these peak highs in between right here, all these peak highs that you see, such as this, all become minor demand areas for me. So what I do with them is I get my zones once again, and I draw these minor demand areas right there. I've got another minor demand area right there. So you can see this is already rejected off it once. This is already rejected off it twice right there. So that's another one right there. And what you're going to see here is another supply area right there that you can see also was a reaction point. And yes, you can also use this point here on the smaller time frames. You can probably narrow it down so it looks, so it's more refined, and you can see it was actually a reaction point. So all these are now your minor demands in the middle. And what you do is once you break through that demand area, it simply just goes. Once you broke through it here, it goes. Once you broke through it through this point, it goes. Now this one hasn't broken, so I'm going to keep it there. And now what you're going to see is in the opposite direction, what I do have is now as we are climbing up, what we're going to have is minor demand areas from the other side. So you can see in this area, we did have, you could say, minor demand here. A lot of people would have been tricked into this. This is the liquidity grab, the manipulation that you would have seen right there, only for the market to keep going because we are in a bullish momentum. And then you could say you have all these demand areas along the way as we are climbing. So you got another one here that you see was respected as when we came back in, pushed up, and now we've got another demand area from this point. So then I plot all these major, minor supplies and demands. Now what I'm going to use as well is the Fibonacci. So Fibonacci, yes, I do use it to measure those retracements. Also, I'm going to show you guys how I also use it. So if I get my Fib tool, I grab it from that swing high to that swing low as well. And I go down to here. So this is all on the daily time frame. I'm not looking at entering or exiting trades. This is purely just looking at what the market is doing overall. So I've got this high and this low. Now you can see all these points become, you could say, also key areas or key levels, what I like to call them, in the market. So let's just plot lines where these are so I can show you a little bit better. Let's go with the 50 as well, sorry, 78. Okay, and now we're just going to get rid of that fib. So these levels, based on that high to that low, become key levels for me. So you can see that was another area where the market stopped. There was also a demand area right there. There was a demand area right there. And you can see the market, that key level was also there. So that's two confluences that you can use. And once again, we're on the daily time frame. I'm not looking at trading or entering trades from this point of view. You've got another key level that the market did find some sort of a rejection to. However, we just went back down. Then you can see this is another key level. And I'm just using these as key levels. You can see the next one is right there for me. Now, with these key levels, what I also have, the next thing I kind of look at with the Fibonacci, after Fibonacci, is my MACD tool. Now, for those of you who don't know what the MACD is, so that's the one down the bottom here, MACD stands for Moving Average Convergence Divergence. So it's a form of an oscillator meaning it's an indicator that's moving between 2 points and it has a zero in the midline. So you can see it's just these two lines, they're not moving averages. They are just plotted on this chart. You've got the zero in the middle. Now, I'll tell you how I use my MACD. To simply put it, how I use my MACD, just get rid of this. is I look at this. So on the daily time frame, I like to use it on the daily because this is what I like to do. You've got your 0 point. You can see it here to the right. So that's in between those histograms. That's the 0 point. I look at this. Are we below the 0 or are we above the 0? If you are below the 0, you are going to be in a bearish environment. And you can see from this point here to this point here, you are below the 0. And you're going to look to the upside from this point here to this point here, we are in a bearish environment. Even though the oscillator was moving back towards that 0, you can see we actually did not go above it. And during this period, the market was moving to the downside. Then when we broke above the 0 and we remained above it, what do you see? You see the market is above the 0. And I did a breakdown on Euro AUD on FX Street a while back. We were all the way back here, and I did say that Euro AUD is extremely bullish, and that's what's been happening through the whole year. Now, another way I use the MACD is I use it for what we call divergence. So divergence is whenever 2 points are moving separately from each other. So it's when you have the price creating, let's say, lower lows, and the MACD is going to be creating higher lows. So two things that are moving differently from each other, they're moving separate, so it's called divergence. Now, if you look at this point specifically on Euro AUD, you look at this low right there, and you look at this low right there. What do you notice? You notice that the price created a lower low. You look at this low on the MACD, and you look at this low right there, and you notice that the lows actually, it created a higher low. So we have what we call a regular bullish divergence at this point. Now, if I also look back in time, I do notice that there was quite significant demand areas from these points right there. So we have this point right here, and then we had this point right here. So I'm going to look at this, the low of this week right there, and I'm going to look at the market came down to break below for that liquidity, where the liquidity would have been sitting, and you could also use the lows of these wicks there, which you see tapped quite perfectly at that point. So now at this point, I had the market hitting this demand area, which was quite significant for me, especially that way on the daily. And then I noticed that the MACD did have a divergence. That's how I was looking at that market shifting in structure and shifting in bias on those bigger time frames. Now, once I saw that, what we're going to do is you look at this point here, and let's go down in time frames now. And let's just look at the 4 hour, for example, and look at this low right there. Now, once we reach this low, we know there's a MACD divergence. We know there's a major demand area, and you see the market impulse quite aggressively from that point. And if we look at that previous high right there, you can see that the market actually went up and created a new high with that impulse. So we actually broke that previous structure. And that was an indication for me that we do have what I call these demand areas, order blocks, people call them different names, sitting within that region. Now, you can see that the market did take some time to come back into this area. However, once it did, we got that beautiful tap right there where the market once again impulse to the upside, breaking these previous levels of structure. And now this black line right there, that was that 38.2 key level. So you can see we didn't move straight away to the upside. We didn't shift that structure to the upside. This here is what we call that accumulation phase. So the market can't technically just start moving right to the upside. It's going to take time, especially because we're analyzing off the bigger time frames. But now once I reach this area, so that was at the beginning of this year, this is when my EA bias started turning heavily into longs, and I was looking at the market being very bullish on EA, especially when I saw the market at this point come back within that area, reject, break structure, and I started seeing these higher lows here. We did break it slightly, but we didn't break this point, and we just started moving to the upside. Then once this high was broken, that made it that little bit more clearer for me. So you can see at this point why my bias was shifted right there for EA to be very bullish for me. Then once we started moving to the upside, you can see that 38.2 key level right here, where we started actually tapping into that area and rejecting. Now, this was a trade that I actually do remember taking myself, and it's quite interesting because now I'm going to tell you guys a little bit about what those liquidity grabs and liquidity traps are and how you can stay, be aware of them so you don't fall into their traps. So as we know, this is where now we're going down to the smaller timeframes to take trades. And this is where your knowledge of those higher timeframes can come into play to really help you. So you guys knowing and seeing what I just did on the daily time frame, how I analyzed using the MACD. As you can see, I'm not using the MACD for anything fancy, simple, just looking on the daily. Are we above or below zero? Do we have any divergence? Do we have any key demand areas? We do. I started seeing the market shift. Sorry, another thing that I missed was the moving averages that I use. So they are quite large moving averages. They're like 200 and above. And as you can see, they do lag behind. That's why I don't really like to use them on the daily time frame, because by the time the market is showing me it's in a bullish manner or bullish momentum, it wasn't up until here that we broke it. So if you're going to wait for your moving averages, you're going to miss this whole area right here of the market being bullish. As you can see, I was able to spot that it was going to switch into bullish from right this point here and from this point here. So your moving averages can help, and I'll show you where. When you go down to that 4 hour. So on the 4 hour, you can see in that bearish momentum, those moving averages were acting as dynamic resistance. And they did actually switch, you could say, a little bit quicker. I mean, we did spot that we were going to switch right here. That's why I don't rely on my moving averages. They did act as nice dynamic resistance here, but I still knew that we are going to break to the upside. So you got the two smaller ones that switched at this point here, and that started moving to the upside, and the bigger one, which lagged a little bit behind. And you can see now we are well and above them, and they are now acting as dynamic support for me. So back to this point right here, the people without that knowledge of those bigger timeframes of what's happening on EA, and that's why it's very important, guys, to just follow 1, 2, or 3 pairs, because as you can see on the EA, like the back of my hand, I have been following it for a very long time, and I know exactly what's going on with the pair. So if you actually want to succeed, you should perhaps start doing the same thing and really master those few pairs. Now, in this area here, you can see that the market created these sets of higher lows right there, right there, right there. But I also did notice that this move right here had those minor demand areas in it. And you can see we broke all these structures to the left here. So all these structures were broken, and we never actually tapped back into this area right there. So if we look at this area right there and we draw a little demand off it and we go to the right, let's imagine that's not there. So what people would have seen, and retail traders, and this is where liquidity comes into play, is you look at these lows, all these lows, and as you can imagine, what's every retail trader going to be doing? They are pretty much going to be looking at a triple bottom. They're going to be saying this is a key demand area, and the market is going to move up from here. So they take positions from this point, and where's the majority of their stop losses going to be? Somewhere within that region, anywhere between up to 50 pips. So this area now is acting heavily as a liquidity zone, where if you guys understand liquidity, the market is liquidity. So all the market is, and don't forget it, don't just think you're looking at pointless candlesticks. No, these candlesticks actually represent buyers and sellers. They are real buyers and real sellers within the market. So when you look at this area, there is now a lot of buy orders with a lot of stop losses sitting in that region. Other than stop losses, you've got all your other retail traders that are putting sell stops, because they're saying, if this is gonna, if this breaks this low, it's going all the way back down, and they're targeting, TPs down at these lows right here. So they're also acting as liquidity. So now what happens? All these big players come in and they want to get the best possible prices for their buyers. And they're putting in massive orders into buyers. So now when you've got a large amount of orders in buys, the market has to find the next best possible price in order to actually execute those buy orders. So what's the market going to do? It's going to impulsively move to the closest places where it can find orders. So the buyers here, their stop losses are buy orders because they have to sell their order to another buyer because they're getting stopped out. So another buyer buys up their order. So as you can imagine, all these big players are picking up the best possible prices from this area. They're knocking all these retail traders out of here. As you can see, there's a lot of orders sitting in this region. And what's going to happen is that the market's going to move right to the upside very impulsively. Now you look at this and let's look at it. Let's look at it on the daily time frame. What does this look like? Bang. That's what it looks like. People see this daily as it's moving to the downside and they automatically assume we have broken to the downside. And then the daily closes like this. I remember our subscription group on Instagram, I did post this and I was in this trade right from these lows. All the members were in the trades right from these lows. I remember this trade very precisely. So now that the market moved to the upside, what are we doing? We are continuing that bullish momentum that we were in. And you can see those higher time frame, that higher time frame analysis. I didn't use trend lines. I don't use trend lines. I'm not using trend lines to take trades. But if I was to use a trend line, all I have to see and all I have to look at is I'll put something like this, or I just run it through the bodies. What direction is that trend line going in? Up. We're in a bullish momentum. My MACD is in a bullish momentum. Everything's pointing to bullish. My moving averages are bullish. So that's all I am using those technical analysis tools for. And what I do teach in my course, what I do teach in my video course is the in-depth ways of how I look at those order blocks, how I look at those supply demand areas, and how I look at those little technical analysis tools that actually work for me. Because I mainly look at liquidity, volume, orders, order blocks, market voids, and where the market missed liquidity in order to come back and grab it. That's what I'm actually looking at. So now let's talk about what's happening on EA in the current times, in the current markets. Based on market structure, another thing I wanted to point out is you look at EA at this point, people will say, this is a trend line. Then they'll say, when we got here, we broke the trend line, that's it, we're going down. I want you guys to remember one thing. Looking at basic market structure, this is a low, higher low, higher low. And you look at now this low right here. This low never broke this low. So up until this point, and even if it did break it and come back in, that's what we would call the liquidity grab, as I just demonstrated. But because we actually didn't grab, can you see now how this trend line is actually pointless? It didn't show me anything. Yes, people might say this is a break and a retest, but it still created a higher high. So that bullish momentum is still there. And now if you look at, people might say we might move the trend line from here to here. Yeah, and you're going to get the same thing. Up until we break this point, we have not shifted structure either, because this is the low, this is the high, and we have not broken this low. So now me looking at this market, what I'm seeing, these lower lows and lower highs here, they don't mean a shift of market structure either. All they are is a correction, just like the correction happened here, just like it happened here, and just like it happened right there. So these are just market structure shifts temporarily for the correction. If we look at this point, what I'm looking at now is a few areas of interest for me, but going back on the daily, we can clearly see that we have a demand area from this point on EA. Also, you can see all the moving averages lie within this area. Yes, we did break the trend line. However, it means nothing to me. That's not what I look for. I'm just looking, it's showing me it's a bullish market. Now, we can also use something like the fib, where we can draw from the swing low to swing high. We can see these 6 to 18, 78, 6, this area, key level of an area. 4-hour, I'm looking at pretty much the 1.60 being this round psychological number, but I am going to keep in mind that we can, go down into, I would say, this 1.598. If we do break that area, what I'm going to do is I'm just going to leave it and see if we can actually go back as low as this red candle right here. And this is where I would say this is the 1.59. So it's 100 pips down from my first area of interest. And I want to see how that area holds up, because even if we break below it, as long as we come back above, that's going to show me, you can see when it's a liquidity grab and the market's trying to grab liquidity from this area right here. And if it does come back in, then that higher time frame is going to tell me that we are still going up. Now, in terms of how I personally trade, I have been catching moves, you could say, in the upside and the downside, because I do trade on the 1 hour. I do trade intraday. I'm trading on the 1 hour, 15 minutes, 5 minutes. And in the subscription, we have been posting trades both upside and downside. So you can see now that my overall bias is only used just to see what type of market we're in. So when we were at this point, I was actually shorting, but I knew when to stop shorting based on this. And then I started going to the upside. So that's what these higher time frames help you to do. And this is what I wanted to show you in this, is how to use that higher time frame, how to use technical analysis to your advantage. And if you guys actually want to learn more about mass dollar trading, just send me a message. You can visit, okay, I'm going to leave the website here. So visit www.opestradinggroup.com. You can leave an inquiry there. You can see the range of stuff we do offer. Also, I do work with a mindset consultant. His name is Pat Bailuni. And what he's doing now, I know a lot of you guys actually do funding, and they try and apply for funding things with all these prop firms. He is doing a 12-week mindset challenge where he is helping traders actually overcome, and become consistent, overcome all their fears, overcome all the barriers and challenges that they do face. So if you guys do want to look at that program, please visit him on www.patbailuni.com. And also he did give me a discount code for anybody that's watching this webinar. So it is capital letters OPES10 to receive a 10% discount. He is helping traders actually pass their prop firm challenges and pass all their challenges and actually help them along the way. He's a great mindset consultant. We do have him on board with us on the subscription service. And now, guys, I just want you guys to just, ask me any questions, ask me anything from this webinar. And I want you guys to just give me honest feedback, anything that I missed, anything that you want more information on or you want cleared up. Is there any questions, guys? Because there's a lot of things I also can talk about. I want to share with you. I want to talk about with you. Has anyone here heard of the term imbalances or voids in the market? If we trade based on high time frames only, then we would have to wait a long time. How do you wait for setup or prepare for one? As I just said, I don't trade based on high time frames. I just showed you how I use high time frames to analyze what type of market and what type of conditions we are in order to help me on the lower time frames execute and analyze and exit trades at the right time. So me knowing that we are in a very bullish market on the daily and the weekly actually helped me to realize that all my shorts had to stop here at this point and then switch them into buys. If you don't pay attention to that, this area right here what it might cause you to do is to start believing that you have switched bias, and you might see it as we broke the wick and we broke these candle bodies and we're now going to go to the downside. And it helps you just fail to recognize that you are still in a higher time frame bullish market. So I don't use higher time frames to actually execute trades. I just use them to help me. It's kind of like a puzzle where you need to put all the pieces together in order to succeed in all aspects of trading. So you need to understand how your higher time frames work and what they're doing, even if you're pretty much looking at the 15-minute time frame like I do. That's what it is. I'll also give you guys a little, very, very little tip, and this is something that I do teach to all my students. If you notice on Euro AUD in the weekly time frame, so we are extremely bullish. And let's take out this week that just passed. And I want you guys to notice something. Between this area here and this area here, how can you see how this is what I call a void? So a void in a price is just like a vacuum, you could say. And this area is a high area of you could say where the market wants to go inside it and balance that vacuum and balance that void in the price. And now if you look at another reason of why I'm starting to look at potential buys coming up on EA, is because if we look at the current week, what do we see? We see that we have actually came down and filled that void. So that's when now, and if you look from a weekly perspective, this is another demand area right there, because this is the area that came and broke to the upside, and we are now tapping into it. That's why now I have all these little critical areas on EA where I do see the market is going to perhaps start shifting back to the upside again. What's the first thing you look at when you open your chart? What the pair's done overnight while I was sleeping. Any other questions, guys? Anything you want me to, discuss in a bit more detail? Any questions that, even if I didn't talk about them, is there any questions that you actually want answered about FX? Even if you're a beginner, is there any questions that you want me to talk about where, something that you're finding difficult, a challenge perhaps, or something that you just want a bit more information on? So you base your imbalance only on the first candle before. I use imbalances. They can be used on everything. So if you look between here and here, there's voids in prices, or these are voids in prices. So it's always between two candles, one on either side of a candle. How do you implement fundamentals together with these technicals? Good question. How I like to use fundamentals pretty much is, honestly, it's the same as like the higher time frame. It's what we're going through at the moment is quite difficult to kind of predict what's happening with fundamentals, because it is something that the whole world's experiencing for the first time as a whole. No trader has experienced what's currently happening previously. This is the first time we're experiencing it. They are like my bigger timeframes where I'm looking at overall direction. So the euro and the AUD, the euro's been very strong against the AUDs because euro has actually been improving a lot in the current situations more than the AUD. What I also like to use, I want to show you something. So this is another little tip. One sec. Can you guys see this screen, investing.com? So I'll go on investing.com and I'll go on indices futures right there. And I don't know if you guys are familiar, there's a concept called risk on and risk off mood. So risk on mood is when people are willing to take risks. So they are investing into your riskier type assets, such as AUD, you know, the euro, the pound. Your risk off means people are not willing to take risks. So they are moving their money into safe havens and safer currencies, such as you could say the CHF, the JPY, into gold. That's another one. So if you go on investing.com and you look at indices futures, so you're looking at the stock markets here. So once again, if the stock markets are doing well for that day, then you could, you know, pretty much summarize that this is a risk on mood, because if people are willing to invest into the stock market, it means people are willing to take risks. So what you do is you come here and you look at this board, and if it's green across the board, green means the stock markets around the world are going up, they're gaining value. That means people are willing to take risks. So you can expect all your risk on assets to be gaining value against your risk off assets. And if this is extremely, you know, red across the board, it means it's risk off mood. And what does that mean? That means people are going to be most likely moving their money from those riskier assets back into safe assets. So if we look at today, for example, this is pretty green across the board. Another one of my pairs that I look at is the pound yen. And if you look at the pound yen and let's look at it across today, it has been, you know, quite bullish across the last few hours. And that's, you know, being represented by the green across the board. AUD and NZD risk on, yes, they are definitely risk on pairs. So AUD is and NZD are both risk on pairs. If it's risk off mood and if there's, you know, a lot of you know, stuff happening around the world where people are worried, they are not going to put their money into the AUD or the NZD. Especially that, you know, you could say AUD and NZD are what we call the commodity currency pairs, where they, you know, heavily dependent on the price of commodities. So yes, they are risk on pairs. So your safe havens are things like the CHF, JPY, your USD, your gold. So you can see I don't put a lot of attention on fundamentals. I do also look at Forex live, but because I'm intraday trading, I'm, you know, looking at entering a trade, going break even as quickly as possible, pretty much. I'm not really too fussed. I just look at, you could say, longer term fundamentals. If my longer term fundamentals, they're obviously going to go with my higher time frame analysis and bias. That's the direction I mainly want to be in. But does that mean I don't take trades in the opposite direction? Of course I do. I still do. So in Euro AUD, just because we're in an extremely bullish market, doesn't mean I haven't caught some sells along the way here. But I still do recognize that this is just a correction and it can end at any point. Yes, it is recorded and it's going to be up on YouTube. How do you decide lot sizes? Sometimes I see you trade different lots. Well, the smaller the stops, the bigger the lots. That's exactly what determines lots. If I'm really looking at pinning an entry and I have an extremely tight stop loss, I'm happy risking, you know, like not risking more, but my lot sizes are going to be obviously a lot more because I'm risking the same amount at the end of the day. So if I'm just going for a 10 pip stop and I'm doing 20 lots on a 10 pip stop on an AUD pair, that's $2,000. It's the same as me going, let's say, 7 lots on a you know, 30 pip stop. So that's why my stop losses do differ. It just depends on the my lot size change, because I am going to be different with my stops. If there is trades that, for example, I do see that have a lot more potential. My confluences are a lot more. I might do the side to risk more. So I do have different risk tolerances where I could say I'm risking, 1%, 2%, 3% of my account. And I am happy to risk that. So that just depends purely on you and your situation, your financial situation. But that's pretty much the risk that I'm willing to go with. Do you trade NFP? No, I don't. And my pairs barely move anyway during NFPs. GJ does move. Actually, they do move, but I don't trade anything USD. I rarely do. So I'm just EA, GA, GJ. Are there any more tools you use to see whether the market is risk on or risk off, or just the stock markets? No, that's pretty much all I use. And it's, it's quite basic, yes, but like I said, I'm not a massive fundamental trader. How many pairs do you trade a week usually? Like I just said, I just trade EA, GA, and GJ. Sometimes I do dabble into GU, EU, AU, but I try and really stay away from USD pairs. I don't like them personally. And if you're asking how many trades do I take a week usually, honestly, it depends as well. Sometimes I'm taking 2, 3, 4 trades in one day. Sometimes I'm taking 0. On average, I would say through the week, I'm taking 5. GA is very similar to EA. And so you could pretty much say that I trade 2 pairs because I never trade EA and GA at the same time, because as you can imagine, they are quite similar. I just use them for whichever one looks better than the other. At the moment, I like EA a lot more than GA, but they're pretty much exactly the same. Like you can see there's the bearish momentum, the bullish momentum since the start of the year, which is exactly the same on GA. You can see we're doing a bit of a correction. However, on GA, the correction looks a bit different because it did break previous structure levels, whereas on EA, it actually looks a lot cleaner. It's moving much nicer. All right, guys. Thanks a lot for joining. Once again, if you have any questions to ask me, just ask me on my personal Instagram, philip.saloom. Please don't fall for the scammers. This is my actual Instagram. There are scammers out there that are impersonating me. This is my only Instagram, and please make sure you have it right. It's PHILIP 1L .SALLOUM. I'm never going to ask you for money. I'm never going to ask you to invest with me. So anyone that does is not me. If you really want to know if it's me, just ask for a photo. Ask me to jump on FaceTime with you. I'm more than happy to. This is my Instagram. Feel free to send me a message on there. And once again, if you guys are interested in getting funded through a funding program, please visit www.patbaylooney.com. Use that code OPES10 for his 12-week mentorship challenge that can really, really take your trading to the next level. And any questions in terms of Opes Trading Group and what courses I provide or how I can help you out along your journey, visit www.opestradinggroup.com. Fill out the form, send me a question, send me a query, and I'm more than happy to attend to it as quickly as I can. Thanks a lot for joining, guys, and I'll catch you next time.